All right, here we have the question from Chapter 8. It's Chapter 8 in the lyrics version, which is associated with Chapter 9 in the Kiso text. So the Wiley Plus Chapter 9 questions are associated with Chapter 8, non-strategic investments. And investments, well, all into corporate investments kind of fall into this chapter. So here we have a situation where we purchased 60 million in 8% bonds that will mature in 3 years. They intend to have the investment available for sale, which means that we're going to record the investment in category called held for trading, or rather available for sale right there, and other comprehensive income because it says it follows IFRS, and so we're going to use that as the investment category here. So we need to figure out what the bond is actually worth. So we've got a couple of pieces of information. We're going to receive interest, or the coupon, on June 30th, and then another one on December 31st. That's good. It tells us that when we bought the bonds, they were 8% bonds, but the market yield was 9%, so we're expecting it'll be a discount bond. The market wants 9%, we're paying them 8%. They're not going to pay us the full face value of 60 million. Then it says, due to changing market conditions, the bond value at the end of the year, the fair value went down to 48 million, and so we need to make our adjustments. It says to make sure your final answers are accurate to the nearest whole number. Take that very seriously. I just did the calculations, and I put in all the pennies, had exactly the right numbers, but they in the old lyrics they would have rounded to the nearest whole number, but they don't in this case. So word to the wise, make sure you don't do what I did. Alright, so we need some dates. We have a bunch of journal entries to do, 4 to be precise. Let's roll up here just a little bit. And the last one is also the 31st on the 12th. So first of all, we need to figure out what these bonds are going to cost us, because cash is going to go down and the investment account is going to go up. So the investment account, we just can type in here investment, and then we'll scroll down a little bit. We want this last one, available for sale through other comprehensive income, and so that's that amount, and then of course we're going to pay cash for them, so cash is going to go down. And this is purchase. Let's try that again. There we go. Alright, so now we need to calculate the value of the bonds. Now if you remember your Business 370, if you've taken Business 370, if not, you have, I'm sure you've already done some calculations with your financial calculator in this course and in others. So we are going to calculate this with our financial calculator. So the financial calculator says that we purchased 60 million in bonds. That's the face value of the bond. So we put that into our future value. And then it says they're 8% bonds, which means that they pay 8% of 60,000. So you can calculate 0.08. I mean, you already have 60 million in your calculator from your previous calculations. So multiply that by 0.08, and then divide by 2, because we've got semi-annual coupon payments. So the amount of coupon is going to be 8% for the whole year, but it's paid in 2 installments. So 60 million times 8%, that should be 4.8 million. And then divide that into 2 pieces, is 2.4 million. So the coupon that we receive every period is 2.4 million. Put that into the payment key on your financial calculator. Now it also tells us that the market yield at the time was 9%, but of course the rule is that N, I per Y, and payment all have to have the same period. And since the payments are made semi-annually, we want to make sure that we record the N and the I per Y also semi-annually. So put in N as 6, because it's 3 years times 2 semi-annual periods per year, so that's 6. And put in your I per Y as 9% divided by 2, so 9 divided by 2 is 4.5. When you have that in your screen, punch in the I per Y, and then you need to compute your present value. So the computing of present value part is the key part here. So it actually works out to 58,452,638. And if you change, I think it's actually 26 cents, but that's the amount that we're going to pay for this investment. Then the first period, we're going to get some cash. Getting cash is always nice. And so we can drag that down to here as well. And the amount of cash we're going to get is 2.4 million, which is 0.08 times 60 million divided by 2. And that is going to be our investment income. So this is coupon 1, and this is coupon 2. They're the same amount, so we can just drag them down here. Whoops, actually that's not quite the case, because let's cancel, let's escape, but we want to make it 0, so there we go. The fact that we paid 58 million means that we're actually earning interest income at a different rate. So the rate that we're earning interest income is actually 4.5%. So it's 4.5% based on the purchase price. So if we just grab this and drag it down there, then we need to multiply by 0.09 divided by 2. So that's the amount of interest income we're actually earning. So we look at the revenue options here, and there we have interest income. And of course that doesn't balance, so we have a problem. The problem is solved by the fact that we have to increase the investment account for the difference, because what we're basically saying is that we received cash of 2.4 million, and the interest income is 2,630,368. Oh, we needed to round that number, so it's going to be a problem. So we need to subtract 0.71. No, we need to how am I going to get the rounding to work here? I'm going to go plus 1 minus 0.7. Okay, so that way I can actually keep my whole calculation in here, which is the opening value, that number, times 0.09 over 2, and then we have to adjust it so it rounds to the nearest whole number, and so that works. And then of course the investment is going to be the difference between those two, which we can see is 230,369. And so now that should balance. Excellent. Now we're going to do the same thing again here in the second coupon payment, except in this example, or in this coupon payment, we actually increased the principal of our investment account. So it went from 58,452 to a higher number because it's increased by that amount. It makes sense because it started as a discount bond, and we're working our way towards the 60 million of present value, or the 60 million of par value for the bond. So here again we can calculate the present value. We can calculate the interest income. So it's going to be 0.09 divided by 2 times, we're going to need some brackets here. I always like to put 2 brackets in. So it's going to be 58,452, 638 plus 230,369, and so that gives us this number. Of course it's got some annoying rounded numbers or non-rounded numbers at the bottom, so we want to subtract 0.32 because that rounds to the right direction. So 2,647,35, and of course that means that the investment needs to go up by 247,35, which is the difference between those numbers. So essentially we're using the effective interest method here to calculate the amount of interest income and adjust the investment to the new amount. And then we have a problem at the end because it says $48 million is the fair value, and we need to adjust for that because we're doing fair value through other comprehensive income. So that's going to reduce the value. So that's going to be an unrealized loss. So we need to go to revenues, and we see unrealized holding gain. That's really not what I want. Let's go to other. There we go. That's the one we want. Unrealized gain or loss on HFT stands for held for trading. So that's the one we want. And the other side of the entry is going to be the investments. Oops, stop. There we go. Drag that down here. Grab that. Grab that. Okay, you're going to be difficult, are you? Let's just go there. We'll go investments. And that's the one we want. Alright, so this needs to be $48 million after we're all done. So, let's figure out how much is actually in our account right now. We started with 58 million, 452, 638, and we added 230369, and then we added another 240735. So that's the amount that's in our account right now. That's cool, but that's not the number we need for the journal entry here. So we're going to go to the end, and we're going to subtract 48 million, because we need the number to be 48 million when we're done. Okay, must not have enough zeros there. Okay, let's cancel. So let's pull it aside. Yeah, that's 4.8 million, not 48 million. Need another zero in that very end there. So we go back here, we add one more zero, and we're good. No, we're not, because I added too many zeros. Okay, there, that's the right number. So we have gone from 58 million down to 48 million. That's about the right order of magnitude. And of course that's going to be the investments adjustment as well. And so this is fair value adjustment, like that. Now the carrying value is going to be 48 million, because that's what we adjusted it to, right? By taking the 58 and adding those two and then subtracting that amount, that leaves us with 48 million. And the accumulated other comprehensive income number, interest income, is actually received in cash, so it's realized, it's not unrealized, and so it actually gets recorded as net income. But this unrealized gain on held for trading investments would be accumulated other comprehensive income, and so that is a loss. So let's grab that and take it down here, and then of course we're going to have to put that in. Let's go to the beginning, minus, whoops, that's not the beginning, that's the end. Go to the end and put a bracket, go to the beginning, put a minus bracket, and that should be it. So key things, we did this calculation in our financial calculator. We did this calculation by taking the semi-annual yield of 0.09, so that was the market yield, and so that's 4.5%, and then we adjusted to make sure that it was round numbers. So the nearest whole number is what we're supposed to be getting. Then we did it again here, but we had to adjust for the fact that we increased the investment in the first coupon receipt to recognize the fact that we were getting paid only part of our interest income, so the rest of it had to be capitalized. And then we subtracted the 32 cents to make sure it was nice round numbers once again. And then finally down here, we calculated the value of the bond, taking our initial value plus the two adjustments for coupons minus the 48 million, which was what his fair value was at the end, and so that's the amount of that adjustment. Let's see what Lyrics thought of all of this. Hopefully it's right. Lyrics liked it. Oh, they didn't like the unrealized gain for some reason. Because we're supposed to find an account called Unrealized Holding Loss, OCI. I'm not sure that we actually saw that anywhere there. But let this be a lesson to you. When you're actually doing this question, you want to see the unrealized gain or loss, unrealized holding loss, OCI account. And I didn't actually see that on my list, but anyway, look for that when you're doing the question. And you'll get a perfect score, unlike what I did. I'm done. Thanks. Bye.